Hello everyone, my name is Morgan. I'm the head of trading at MS Equities Trading. For today, I'm going to be doing a live trading session on quite a great trade idea. It's a trade idea I've been watching for a couple weeks now, and it's my specialty. This trade idea is on the oil markets. Oil is a commodity I've been trading for the better half of a decade, and I've made the most amount of profit off of trading oil. So I'm going to do a quick update on the previous live trade session that I did. That video was on Euro Pound. So if you want to jump onto my channel, just go to the live section. You'll see the last trade idea was on Euro Pound. Now that trade is working out really well, which has been great. So let's just quickly jump onto that chart and then we can have a look at what's happening there. So you can see that, of course, please go back to the previous live because that's going to give you all the information and I don't want to waste your time talking about all of that. But what I had mentioned is that I was watching how the Euro Pound was moving up into this zone over here. I'm just quickly going to clean up this chart. So you can see that the Euro Pound was reaching this historic resistance level. The market had moved up to it more than once before, and you could see that the market was testing this level. Now, I started short selling into this market, give or take around about somewhere here. I started short selling into it and I hit my last short sell right up at the top, right at the pinnacle. I was watching this market level test over here and it just didn't want to break through. Now, what happened was the market began to break down during the week. We had a really strong sell-off to the downside over here, and this was on the 1st to the 10th, so that was on Monday. Now, the struggle was that I wasn't ready to close out the position. I felt like the market was going to continue moving, and I held into that position as it began to retest the previous support. So it was forming up a bit of a Gartley. So you can see here very simply, if I were to set this resistance level up. So Gartley is past resistance equals future support, or past support equals future resistance. Now this market basically sold off from these highs over here. This was 0.874, sold all the way back down into these lower levels here. And once that market had that pullback and retracement, I knew that it was probably going to test the previous support as a future resistance. And that's what happened. The market tested this level and began to break down on Friday. So it was a bit of a nail biter. I would have liked to have taken my profit, but then again, trying to stick to the system is much more important than the profit I make, because yes, I could have taken a good amount of profit off the table, but that's really not that's not the best thing that you can do for yourself as a trader. You really want to stick to your system. So if I were to take a look at the daily candles, you can see how these candles were constantly testing this upper level and it was continuing to break down, continuing to break down. So this was Thursday's candle. You can see Thursday's candle was quite bullish. Wednesday we had a very strong bearish candle, and then Thursday we had a bullish candle pushing back to the upside. By Friday we had the market close bearish. So on the weekly charts, you can see we've got the first bearish candle here, right next to this previous candles. So they're both more or less spinning tops. This is a bit of a evening star or morning star. In terms of the setup going forward, I believe that the market is going to continue pulling back. Now, next week, it's going to be important to see what that next candle looks like. If that next candle is bearish, that's going to be great. You can see over here, historically, there's been quite a strong bullish engulfing candle. The market has also tended to gap open after these pullbacks. So that's really what I'm waiting to see, is if we can get this market to pull back to these historic levels. Something that I had shown in that trade was that there is a bit of an ascending triangle here that you can see. So this is also something that I'm watching for, is that if on this trend line, I'm just going to go to the hourly chart, if on this trend line we see the market obeying this level, this support level, then that's also going to be something that I might consider getting out of the position. So although I'd like to see the position move all the way back down to these levels here, I don't believe that's going to be happening. Now, from a fundamental perspective, the euro is staying with lower interest rates while the pound is going to a stronger interest rate. So the pound is strengthening over time, which makes sense why you're going to see uh, the pound selling off. You know, on euro pound, if you see this market fall, that means the pound's getting stronger and the euro is getting weaker. Now, it's not necessarily that the euro is getting weaker, but the interest differential between the two is about 2%. So the great part about this position is not only are you short selling into strong technicals, strong fundamentals, you also having a positive swap interest rate. So the great part about this trade is I've been holding it now for about 3 weeks, and I've been earning interest on my swaps. So that is also another part that's a little bit more technical for traders to look into. You know, a lot of retail traders don't consider their swap rates, but when you're in a position where you've got a positive swap rate, it's great because you're earning money on the swaps as well. So with that swap differential between the euro pound being quite high right now, great swap to be earning. So I'm going to be holding this position, seeing if it can move all the way back down to this historic this historic support level. So it's going to be one of two zones here that I'm going to be looking at. I would be able to look somewhere inside of this zone of expectancy. Now that is that's quite a large area, but that's really what I'm anticipating, is that the market's going to move somewhere down to this level. This is the 0.866 level, give or take. It's round about between 0.87 falling all the way back down to 864. So depending on how the market looks, I'm gonna watch the market open next week, and if we see the market continue down to this trend line, I'm definitely going to consider my options for getting out of the position. What I might do is, considering I have about 3 different trades now, I have 5 short positions on this single trade. I'll probably close 3 of them out closer to the trend line, and then see if I want to wait for the last 2 positions to see if it moves all the way back down to this historic support level on this horizontal line here. So I would take a portion of my trade, leave the rest in to see if I can make a bit extra. So wrapping up this trade, let's get into what this live trade session is about, which is the US oil markets. So for US oil markets right now, I'm considering a lot of different outcomes for this trade. This trade is both heavy on the technicals, but also very heavy on the fundamentals and the macroeconomics as well. There's definitely a lot happening in the market, but in terms of the macroeconomics, I believe that it's best to leave that to later, to the end of the video, because although they're very important, there's a lot of understanding that those macroeconomics and those fundamentals have already been priced into the market as we speak. So although it is news that came out today, which I'll talk to you about, you know, it's probably not going to be a major impact or effect on what we're looking at right now. So for the general overview, the markets have been sitting around the $70 to $60 level for a considerable period of time. So this red line that I've got here is the $60 level. I'm just going to drag this horizontal line up to show you where the 70s are. There we go, we're sitting at 70s. So you can see here that the market pulled back down to these levels. There was a lot of volatility coming out during the bombing strikes in Iran. and that was definitely causing a lot of volatility to the market. You know, every time there's been a even big potential, small potential for war in the east, the oil market prices just shoot through the roof. So that in itself is a great trade idea. But you can see here in around about, let's go back here because this is quite an anomaly of data. But you can see that historically the market was sitting well above uh, these levels for most of the 2020s. So if I'm looking at give or take 2020, you could see this was lockdown, this was COVID. And then you could see as the market continued to push back up, this on the left was also a lot to do with manipulation in the oil markets overseas in Saudi Arabia and stuff, but that's history. We're not going to talk about that right now. But then you could see the market spiked all the way back up into the times around the war in Ukraine, and then that price came all the way back down and stabilized around $60. Now, the markets historically for oil, for the US oil, sits in a bracket of around about $65. I stand to be corrected, but the oil markets sit at an average price over the last 10 to 15 years of $65. And that's the bracket that we are talking about now between these two red lines. So you could see how the market sat around this $70 level, tested that level, and then broke below it. You can see there was a lot of volatility here where the market wasn't entirely sure if it wanted to be 70 or 60. And then you could see this price rejection, the market spiked all the way back up and then sold back down into those 60 levels. And you could see this consolidation here of how the market broke below those 60s levels. So, you know, this really is a swing high, swing low, and then, you know, consolidation. And like I said here, with these three very large candles here, that was around the time of the bombings in Iran, where the US decided to bomb them. So it's a lot of extreme price data that's not necessarily showing the structure of the market. And you could see how the market returned back into this level of the 60s. But now what you're seeing is the market is testing the 60s level again. Now, historically, you can see that the market hasn't tested the 60s levels right since, other than this consolidation. The last time it tested those 60 levels was back in 2021 in August. Now, that is a long time ago. So you can see how the market has stayed well above these 60s levels, and only recently coming into around about between uh, April to May, the market fell to a level of about $58, then $56.78, then $55.53. So the market has the market has consolidated since then, but now you can see it's moving back to those 60s levels. So in terms of the levels that I'm looking at right now, I actually pre-wrote this because I'm on a new computer screen that's smaller than the one I normally use, and I'm struggling to see the levels. But in terms of the levels that I'm looking at really closely, focusing majority of the price data on the times in 2025. So I talk about three levels: continuation, a retracement, and a range. Continuation means if the market continues to move, where could be the next targets. Retracement is if the market pulls back, where could be those targets. And then the range is what that price could be moving between. And that's usually a combination of the first level, the continuation level, plus the retracement level. So for continuation zone one, I'm looking at a price of around about $60.66. We're already sitting $60.58. So we've already broken through that level. Earlier on in this week, I took a position. I took a trade at the $61 level. So I'm already in a loss on that position, but I've taken a small position there. That's when I took these levels. So we're already past that $60.66 level. My second zone for continuation is the $60.27 level, or moving down to that $60 whole number resistance, which I'll talk about later. In terms of retracements, where could we be moving to? $62.57 is on my first level, and $63.10 is my second level. So just to look at the retracement zones, you can see that the market historically around about this time, there was a lot of support set up on this zone. So this was back during this year. You could see that the $60 level was respected quite well. Now, looking into these levels here, in terms of a retracement, I mentioned that it's about $62.50 to $63.10. So you can see the 62.55 levels around about over here. That is give or take a 50% retracement. So if I were to set up a fib, you're looking around about in these levels. So this is your $63.10 level, give or take here, which is a 50% retracement of the current sell-off that we've had. That is often a level that you will see, but again, you can also see that there is a lot of support and resistance in the middle of these zones here. Historically, you had the market falling down to this level here, which is the $62.70 level. And then you've also got these levels over here, which is sitting around the $63.20 level. So there historically has been more than once or twice where this level has been tested as a support or resistance. And that's why psychologically the market is going to seek those levels once it retraces. So in terms of an average range, I'm looking at a range of between $60 to $64 a barrel. I believe that anything inside of this range here is definitely probable if we are able to keep above $60. Now, if we break below $60, we could see the $60 becoming the new resistance of that range, therefore forming a Gartley like I showed you on Euro Pound. However, you could see definitely that if we see the market moving higher, we could see that market moving all the way back up to those $64 levels. Now, would it be on the initial retracement? Possibly. Would it be on the second or third? Probably. So meaning there might be more chance that it could take 2 or 3 moves before we see the market recovering to that level. So in terms of the other aspects that I'm looking at on this trade, they do include some of the work with indicators. Now, indicators do give you lagging information, but what does help is when you're trading the larger time frame, like the 4-hourly, the daily, and the weekly, the indicators do tend to be easier to use. Whereas when you're trading on the smaller time frames, I often say to people, rather trade price structure. So going to the weekly, you can see that on the stochastic, we have the market moved all the way down to this oversold level. So the market is extremely oversold over here. And you can see that historically, when that market was oversold, you could see that it began to retrace. Now, there was a break below during this time. There was that market spiking down twice and then retracing back up. So that definitely did show that there was a bit of noise in among that level there. But you can see as well over here, the market spiked all the way back down to this level and then retraced back up. Now this is definitely very noisy. You can see how the market pulled back to this level, became oversold and then retraced, but then there was a lot of noise here. So there was probably not as big a move as people expected. However, that spinning top candle forming right over there would have been a great indicator to show you, hey, maybe you should consider getting out of this position. Furthermore, you can see that on the daily chart, the market is also oversold. So you've got the weekly is oversold, the daily is oversold, and the market has moved really strongly all the way down to this level. You can see that there were no bullish candles. There was nothing getting in the way of this. The market sold straight through all the historic supports, and it moved all the way to that around about $60.50 level that it's settled at now. But you can see that on the daily there has been a bit of a spinning top candle formed at the bottom there, or they usually call them gravestone dojis, but everyone has their own terms for candlesticks now. Then going into the 4-hourly, you can see that the 4-hourly is also oversold. So with that weekly, daily, and 4-hourly being oversold, that's definitely a sign that the market could be uh, oversold on multiple levels and not just one level, which does give you confirmation that the smaller time frames are reflecting what the larger time frames are seeing. Going further, you can see that once that level settled over here around about there, you can see that there was a lot of noise in the market movement. Now, this noise you can see is the market not really deciding whether it's going to move bullish or bearish. And a lot of that is coming through the news that it's been waiting to receive over the last week. Lastly, the hourly is showing a divergence. So you can see over here on this hourly time frame, although the market has continued to sell off, you can see that the market is showing divergence over here. So the market was showing divergence here, and then that level was broken. So I would say that there is definitely more than one level of divergence, but it's always important that you are able to select both and see that the market has broken its previous divergent level. So you can see that as the market is falling, the MACD is losing momentum. And what is that showing? That there's less buying or there's less selling pressure in the market, which means that the market could continue to a sentiment where there's more buys than sells in the oil markets. Now, currently, that's not happening. What's happening is there's less sells. And that could be also because the market has fallen so hard that people are closing their positions out and buying back their swaps in the market. Now, further than the MACD and the indicators, what I have been seeing on a larger time frame is that you have that descending in price. So you can see that the market has continued to contract and it's consolidating to a lower average price. Now, that's obviously coming from the pressures that have been seen with global economic tensions, with wars taking place around the world. And as that year has progressed since around about 2022, when you had the invasion of Ukraine, the market spiked all the way back up and then has sold all the way back down to this level. And you can see that the market wants to consolidate to cheaper oil. Now, it always makes sense that the oil markets will consolidate around about that $60 level. The thing is, if oil is too cheap, then it's too expensive to drill the oil. If the oil's too expensive, then it's too expensive to buy. So it's always a fine balance that they're trying to keep with the oil markets, which is why you have EIA, the EPA, and OPEC. These are governments, or I think they're government agencies, but they are conglomerates of countries all around the world that are focused on creating, they call it stability in the market, but it truly is market manipulation. But it makes sense. Like it's something that both sides agree to, because it's like, well, we don't want to have oil that's too expensive because then no one's going to buy it, and then our margins are defeated. But then if oil's too cheap, it's not worth drilling it out of the ground, because the cost to run an oil rig is expensive, and the cost to process crude oil into the I think there's 14 levels of petroleum products, fuel being probably the most consumed part of it. It costs a lot of money to do that. And if the crude oil price is too low, all of a sudden your margins are gone. So keeping a governance of price to the oil markets is an expectation, and it's something you see quite often. So I do believe the market creating this descending range, although you could see the market sitting at that $60 level, going into the macroeconomics of this will explain a bit better why you're seeing that. So what we have been seeing, and I'm actually going to just pull up the article for you. So a great place to go for information about oil is OPEC, so the Organization of the Petroleum exporting countries. So OPEC is more Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, Algeria, those kinds of places. And then you have the EIA that manages places like America and a lot of the Western countries. So under their press releases, you can see that today there was a press release. Now, this is a very important press release. So the market has been agreeing since 2023 to increase production. And now, if we were to go onto the charts, what happened in 2023? You can see around about this time that the market was coming back down to these levels. So they were stabilizing those oil prices and they were trying to create more output because now, why? Oil is not too expensive. It's in the roundabout the right belt so that they're going to try and pump out as much oil as possible because not only is demand increasing, but also it's a good time for oil because it's at that price zone that I was discussing with you. So the market did consolidate, and it was specifically because of the outputs. So what you can see here is they previously announced additional voluntary adjustments in April and November 2023. So what they had done is they had increased from the 1.65 million barrels per day, additional voluntary adjustments announced in April 2023. This adjustment will be implemented in November 2025. So what happened in November 2020, or what happened today? So today, OPEC plus countries met and decided to add 137,000 barrels per day to the production from the 1.65 million barrels that was already agreed upon between April and November in 2023. So they've decided to increase their production. Here's the ironic part, however. Back then, they increased the production because their stocks were falling. And when inventories fall, it's because too many people are buying oil. However, the difference is now the oil price is cheaper than in 2023. There is more stock in inventory now than before. Excuse me. So, and most importantly, petrol prices or petrol consumption is at a 6-month low. So, petroleum products being the number one part of crude oil that is consumed, they're at a 6-month low, and yet they're still increasing production. And that's why you can see here the market has been already pricing that expectation in, because although this press release has been released only today, everyone knew this was coming because they have an expectation. There's interviews that are done with certain individuals that are members of OPEC, and they talk with them and they discuss what is your outlook. And of course, the outlook was discussed prior to the meeting. This was only an agreement that had taken place. So different to 2023, where you could see after those agreements, the price of oil spiked because now all of a sudden there's more available stock to buy. And because it being just after the invasion of Ukraine, a lot of countries were stockpiling oil. Whereas now there seems to be a lower demand for oil and countries are still sitting on stockpiles. So you can see production is increasing, demand is decreasing, and inventories is increasing. So although the oil market is falling, and this news is definitely a warning to us of this trade, in itself, it does somewhat contradict what the market should be looking for, which is probably stabilizing production and not increasing production. However, you can also see that there are often geopolitical fights that take place between OPEC and EIA, where these countries, the Western countries and the Eastern countries, will often fight over EIA will, or the US will release a statement saying we need to reduce production, and then all of a sudden OPEC increases production just to be like, hey, I'm going to stick it to you because I can afford cheaper oil. So there's a lot of macroeconomics playing into this trade. However, it's not entirely critical to look at that, just to understand that there was an important meeting that took place today. That's the gist of the meeting. And going back to the charts, we can at least know, keep it in the back of the mind, but then still look at the trade idea from a technical perspective in saying $60 oil hasn't taken place since back in 2021. So we're looking at 5 years that the oil market has historically sat on that $60 level. Now, like I mentioned to you, we did have that time earlier this year where the market did break down and moved all the way back down into these lower levels. But what did you see beyond that? The market immediately came back up and created a consolidation. So like I was saying to you, swing high, swing low, swing high again. So you can see that how this market had quite a strong sell-off into these levels. You can see that that market consolidated and moved back up to the previous highs and even broke the previous highs. So you can see that the market wants to sit within that $60 level. Now, to close off with, this does sound like confirmation bias, but the point is you have to take a side on a trade. You have to either be buy or sell. You can't be both. Now, you can be both, but it is a bit contradictory. So from my perspective, looking at what we've discussed in this video, I do believe that with the markets being oversold on the weekly, the daily, the 4-hourly, divergence showing that $60 whole number resistance, and all the other points that I discussed with you, there is a probability that you're going to see the market bounce off that $60 level. Now, what if you don't see that market bounce off that $60 level? Simply put, you get out. Now, getting out may include losing a bit of money, but that is part of trading. What is important, however, is that you can keep this trade on your radar, watch it closely, and decide when it's going to be the right time to get in. Now, is it going to be the right time to get in at $60? Is it going to be the right time to get in at $55? Wherever that might be, that's entirely up to you to decide. But for me personally, I mentioned earlier in the video, I got in at $61. I was early to the position. I felt like $61 would be a good start to the trade, so I decided to get in with a smaller position, and the market did continue to fall. So in terms of risk management, just looking at that, if I were to take now it's very difficult looking at this, this chart, but if I were to take a rectangle and give you possible entry zones. Now, for my first predictive entry zone, I would be looking at if $60 is the level that I'm going to be watching, then let's call it $59.70 is my hard stop limit. So $59.70. If the market moves below that, I'm cutting my trade. Now, the reason being I'd put it below $60 or 70 cents below is because the market could spike below 60. But then in terms of profit zone, I am looking, like I mentioned to you, at that previous level between $62.50 to $63.10. Now, what I do on that trade is I'd add to the position. So I am considering adding the position first thing Monday and being able to get some more trades in that $60 level. So hard stop limits on the first scenario, 60 is not broken. Stop loss is set at 69.50. So that's around about here, give or take. So that's going to be my hard stop limit, around about inside this zone. And then my possible take profit is going to be between 62.50 and 63.10. So let me just find 63.10 here. 63.10 on the mark. Oh, I'm good at this. So that's going to be my possible zone for when I'm looking at take profit versus stop loss. That's going to be roughly where I want the market to moved to. Now, it's not much, but the reason being, as you can see here, after these strong consolidations, you've had the market move high, pull back low, move high, pull back low again. Now, I don't necessarily want to be holding this trade for a long period of time, but because the oil markets are a bit more predictable, if I get that push to 62.50, take my profits, wait for the market to pull back, get back in. So it's not the end of the world if you're not capturing the full movement of that swing. Now, if that market breaks below $60 and we're moving into those lower zones, then these are going to be the zones that I'm looking at, is these historic levels. So like I mentioned here, we had the market move to $58, $56.78, and $55.53. Now, if we see the market moving to those levels, great. I mean, that could be quite a big trade opportunity, because you're going to have that very strong pullback and you're going to have that market moving higher. So what I'd consider is that $60 level is broken and I can see the market wants to continue moving lower. I might enter a sell position that is equivalent to my buys, and then that cancels out the loss that I have on that trade. That's a slightly more advanced risk management strategy, but that could be better than exiting your positions. And then I would hold that, hedging my position, I would hold that sell and buy to the downside, and I would be taking a look at getting into the market around about on this level here. Now, there could be a better zone to get in on. I'm just going to quickly make this a different color here. There could be a better zone to get in, but if we see this market moving down to this level, this is going to be my new entry zone. The reason why I'd make my entry zone a little bit bigger than what I've currently got here, because $61 to $60 was really my entry level. It's tight. I would make the market a little bit, I would make my entry zone a little bit bigger here, because with such a strong pullback, considering the historic moves, with a very strong pullback, you often see a very strong retracement. So that would be where I'd look at and say, okay, I'm looking at between $55 all the way up to, let's say, $57. So I would make a $2 or $2.50 entry zone. And anything within that zone, I'm setting up buy orders and I'm adding to it. Now, it is a higher risk to do something like that, but it's about creating opportunity out of predictability. Now, what is the predictability that the market moves $5? Yes, it's this predictable. What's the predictability that the market moves $10? It's less predictable. So you're having to weigh risk against the opportunity of what's the odds that this could happen and what's the odds that there could be a strong retracement from that. So scenario one is the blue squares. Scenario two would be the entry for my green. So if I were to take this and look at a possible swing high, you could see anything inside of that zone there. So this box right at the bottom here being my potential entry, and this box over here being my potential take profit. So I would look at, if we move all the way back down to this level, I will cut my sell orders, enter my buy positions, and hold that to the upside. So that's really what I'm looking at right now. But like I mentioned, this macroeconomic news that came out today with the OPEC plus countries increasing production, personally, I think that the market is pricing that in, and very quickly they're going to start realizing that inventories is rising, consumption of petrol is dropping, and they're going to probably look at some supply cuts. Now, it could be the EIA that does this, because OPEC is far more robust. OPEC tends to produce at a much cheaper price than America does. So that's why they might not mind $50 oil or $55 oil, but the EIA will mind. So that is just being able to give you a lot of interesting aspects to this trade that I'm considering and that you can consider now as well. if you have more input and ideas for what you think this market could do, where you think this market could move to, then feel free to drop a comment down below and I'll be able to discuss those in the next video. I'm just checking here. Someone, uh, oh, yeah, previous student of mine. He was with us back many years ago. Yeah, good to see you as well, Michael. I took some time off to build a couple of houses, but I'm getting back into trading. It was actually great. I mean, getting into investing in property is very stressful, but it's very, very rewarding as well. All along that time, I was trading the markets, but now I'm very motivated to get back into the educational side as well. Uh, it really, my biggest inspiration for getting back into trading, ironically, was the fact that I was watching uh, live streams, like these live streams for trading would pop up, and these guys were just sharing absolute rubbish. Like they were literally purely gambling, like trading 5 and 10 minute charts with no technical analysis, just like, oh yeah, this is probably gonna pop now. Like, and hundreds or if not thousands of people watching these live streams and consuming this content, and it's like, how is this possible? Like, how is it that these guys attract such a following and have such little understanding of the financial markets? And that actually really inspired me to get back to my educational background. And I'm really looking forward to also launching out some new courses very soon. So, yeah, stay tuned, Michael. Good to see you as well. And I'm going to definitely carry on with these live streams. As long as I have new trade ideas, you're going to see more of me. So once again, everyone, thank you for tuning into this video. Make sure to jump onto the YouTube channel if you want to see more videos like this. I have lots of different trade ideas that I share, lots of different strategies and ways of doing things. So make sure to take a look and see what you think. Uh, Subscribe to the channel so you can keep updated, and I will make sure to see you in the next video. Once again, thanks so much, and cheers for now, everyone.